Hello and welcome to this week's Market Outlook. This is Jeff Bish, president of MarketGauge.com, filling in for Keith this week. So I thought I would start with the chart that is floating around emails and blogs to the point of just being insane. To the point of if you've heard it from too many people, you just can't believe it. But nonetheless, I thought it is an interesting comparison, and that is a comparison between the Dow in 1929 and the Dow currently. So as you can see, after I pointed out, we're looking at the Dow in 1929 on the top chart, and on the bottom chart we're looking at the Dow, you can't see it quite as well, currently. So first of all, I have to preface this by saying in no way am I suggesting that the pattern that we saw in 1929 is repeating right now to the point where we could look at the charts and say, look, it happened in 1929, it's going to happen again. That said, there are some remarkable similarities, and I will go one step further and say these similarities exist all the time in all kinds of charts. And the fact that it happened in 1929 is probably a better study on a more generic chart than to actually worry about what's going on right now. And by that I mean what happened in 1929 on the charts happens all the time. It's a great pattern to know. And we could be, in fact, tracing out a very similar pattern right now in the current Dow. So 1929 or not, this is a pattern you should know. So let's look at it in 1929 just to humor the fact that that's the reason I'm starting here. So Dow 1929 consolidated. For your information, the magenta line is the 50 simple moving average, and the black line is the 200-day moving average. It's daily chart. The green line is a 10-day moving average. They're all simple. So the pattern that recurs all the time, not just in the Dow in 1929 and the Dow in 2013, is you got a nice consolidation. You break out of that consolidation and you move up. Now in this case, you didn't move straight up, you consolidated. In other situations, you might get a swing and then another swing up to the what will become the all-time high, at least for right now. So currently, in 2013, we consolidated. We made a move up. We didn't consolidate in the same way, but we sold off, kind of back down to the 50-day, and then we moved up to a new high. So here's the pattern that I'm saying you should know on any chart, and it has nothing to do with 1929. The market sells off. It breaks the 50-day moving average. It breaks a prior swing low. And then it holds at the 200-day moving average, just as it did in 1929. Now, whenever this happens, a sell-off to the 200, you want to be very careful about how quickly and how the market acts when it gets back up to the 50-day moving average. So in 1929, this is a classic retracement back up to a 50-day moving average that has now rolled over. All right. So the Dow, although it took out its 50-day moving average on Friday, did rally right back up to the 50-day moving average that was rolling over. That is a very important area to watch. If the market rolls over from there, it's very dangerous. Will the market collapse like it did in 1929? Well, two thoughts there. One, not necessarily, and two, if it is going to collapse, the breaking point, very well illustrated by 1929, is when it takes out that swing and the 200-day moving average. So if you want to sleep at night and not worry about 1929 hype, then the thing to focus on is so long as the market does not take out the 200-day and the swing low down here, then we cannot have a collapse like we did in 1929. It's going to have to take that out. This, for some of you, is going to sound really silly, and for those of you that this does sound silly, there are people out there, traders out there, who this could be a kind of an aha moment. Until we get below this level, it is very unlikely that the market will collapse. In other words, it's not going to go from 16.5 down to 14 in one day. All right, more likely, if it's going to collapse, it's going to work its way down, test this level, and then collapse. That's when you should start getting worried. Now, that said, had the charts, the 1929 hype been out there, I would have been saying something very similar. We're back up to the 50. We're not out of the woods yet. If we come back under the 50, you need to get a little bit concerned on the downside, and in part because you have not really taken out this prior swing. You're still sitting below significant resistance. So the market sold off rather hard, and certainly the hardest it has in quite some time for us recently. So the bounce here was rather fierce, and this is where the market really gets tested. All right, so with that said, let's move on to the rest of the markets. And this pattern, rally back up to a 50 that has now rolled over, plays itself out in tons and tons of stocks, and it's a great pattern to know if you want to look out for stocks that could be on the verge of a significant change in their trend from the upside to the downside. But once it gets back over that 50 and keeps going, you can't or you shouldn't be screaming fire anymore. So let's take a look at the rest of the Market Watch. And I am going to focus our attention, here we go, on what I think is probably the most important chart right now in the four major indexes, those being the SPYs, the Dow, the S&P, and the IWM. So we're looking at the IWM. This is the Russell 2000, and it has a really interesting convergence of trend lines and the same pattern that I was just talking about, which is you can see the magenta line here is the 50, and now that 50 has kind of rolled over. Didn't make it down to the 200, but this bold trend line is a closing trend line, and this hairline trend line here is a trend line based on the lows from the, I guess that's the November 2012 lows. So when the market broke that trend line, and now that you know where it's coming from, let me zoom in. When the market broke that trend line, that was a pretty significant event. And you can see that it respected these two trend lines, and then when it broke it, you had somewhat of a little mini panic there. So now, just like with the moving average, we're back up to the moving average, testing it, and we're also back up to the trend line. All right, and we're also back up to a prior swing high and a prior swing low. So this whole area in here is an incredibly important area for the IWM, which happens to be one of the broader measures that we're going to look at. So for that reason also, it's one to really watch as a barometer for the overall health of the market. The simple way to watch it, if you're worried about the bearish side, is to just be more cautious as it starts to move back down through prior day lows. So yesterday's low is right on the 50-day moving average. The low after that is going to be right down here, and I would say because it lines up with this level, this 111 level should be significant support. So if you want to be bullish but you're cautious, I'd be focused on the 111 level, and as long as that holds, the longer term trend has a good chance of being intact. If you want to play it tight in terms of getting out of a bullish stance, the 111 is the important level to watch. Now, let's take a look at the others, however, because if we look at all four, we've got a really interesting divergence going on here. Now, I've already talked about the Dow, so the diamond's down here. I'm not going to spend any more time other than to re-emphasize the fact that it's been unable to get back through that high. Friday was the first time through the 50. The SPYs did get through that prior swing high, and they're bumping up against their all-time highs right here. So they're running into resistance as well. IWM's down here I just covered, and the Qs have broken out. So the Qs are leading. Now, whenever the Qs lead like that, I'd like to take a look at the broader NASDAQ market, so the composite. Now, this is another broad measure. I said the IWMs is one of the broadest measures. So I like to look at the NASDAQ composite as well as IWM to get a broad measure. And in the case of NASDAQ, this is bumping up against its prior highs. So this lends more credence to the fact that the tech and the Qs may have some legs and may be able to continue to move higher. However, with the fact that we've got 3 out of the 4, if I go back to the Qs, still under those prior highs, it is definitely a warning sign that the markets may not, they are not all back in gear. If they're all back over the 50, that's good, puts them in a bullish phase. So we can still remain to be bullish, but we'd be cautious and get more cautious if it pulls back down through the 50. So the next question I would pose is, we've had a really strong run-up. Has it gone too far, too fast? Because what we're going to look for if the market consolidates is the Qs to hold about that 88 level, the SPYs to hold, as I said, prior lows and the 50. The diamonds or the Dow, I would say we'd like to see them hold the 50, but I'll give it down a couple lows. So yesterday's low and the day before's low. If the market's going to consolidate, these would be good areas for it to consolidate. And that's really what I would expect to happen based on the run-up and based on what I'm going to show you right now. So let's take a look at some of the market internals. Or actually, before we do that, let's finish this up with the TLTs. If the markets get weak, what we don't want to see happen is the markets getting weak and the TLTs getting strong, indicating fear. It's okay if the stocks sell off a little bit and start to consolidate, but we don't want that to happen. We want that to be a good digestion. We don't want it to happen in the context of fear. If it happens in fear, then that's an indication that the market could be rolling over here. And as I said, after a big dump down to the 200, you don't want to see it come back under the 50 and then back under that level. And certainly with the TLTs having the opposite pattern, rallying up to the 200, not even getting back to its 50, if it takes out this level here, that could be an indication of fear, and that would be an indication that the markets want to continue in that direction, and that would mean down for stocks, down for interest rates, up for bonds, which is what you're seeing right here. All right, so that's the pattern for the bears to be hoping for or watching for, and that's the pattern to watch out for if you want to be on the bullish side and know when it's time to step back and say the bulls have just lost control here. Now, another interesting market before we go on to the breadth, Keith talked about this last week as well, is the gold market. This too is getting a lot of attention right now, which makes me a little bit nervous about feeling like we're on to something. That said, you can't argue with the charts, with GLD putting a really nice, almost triple bottom here, and somewhat of an island formation, and then rallying up to the 50, consolidating, and a nice accelerated move up through the 200 after breaking a trend line that Keith had pointed out in this outlook last week. So what does all this mean for gold? Well, it certainly means like we have a good looking bottom trying to be put in place. Whether or not it's extended right now is hard to say. It certainly looks like it, but it would for me mean that if we pull back down into this area, I'd expect some support. So that's a much different picture than what we would have said if it were to pull back from this consolidation. So gold, definitely something to keep our eye on. And again, this would be interesting too if it were to get moving with a market decline. So keep an eye on GLD and also GDX. They're both moving in the same direction, in the same way, which lends some more credence to the fact that this may be bottoming and have some legs. All right, so you can see GDX did a similar thing, consolidated nicely over its 50, ran up, paused at the 200, and now has broken out over the 200. This takes out some pretty major trend lines. All right, it's taken out some pretty major levels in terms of moving averages, and also taking out some swing levels. So this is definitely worthy of your attention if you want to trade on the in the gold area. So let's now take a look at the market breadth, and I'll pull in a completely different set of charts here to do that. So here's where I'll take a look at whether or not the run-up has been too much, too fast. Now in terms of market breadth, we're looking at the McClellan. Keith looks at this with you every week, so you should be familiar with it. If you're not, let me just point a few things out. Here's the 150 level. Over this 150 level, and if I scrunch it down, you'll see that over time, if we get over this 150 level, we look at this as being somewhat overbought. Does it mean it can't keep going higher? No, but what you want to do is wait for it to kind of roll over a little bit, and then it could indicate that maybe enough is enough. It doesn't necessarily mean we have to crash and come back down to the lower end, but it does suggest, with a big picture view like this, that S&Ps, or the markets in general, really, I should say, have had a run that needs a rest. And that's why I said earlier, I'd look for consolidation. The market definitely has some momentum, but it's coming into resistance. It's really used up a lot of upside in terms of its breadth, and therefore it's just ripe for consolidation. The price pattern isn't necessarily ripe for reversal, so we want to follow the price patterns, not the breadth in terms of our trading. So from a price pattern, we don't see any reversals forming, but that can happen as quickly as a day. If we take a look at a slightly different view, but again, same data, advanced decline data on a 10-day cumulative basis, has gotten to a level that is overbought, but we tend to look at this in a way that we want to see it come all the way back down, back under this band right now, which is at the 2000 level in terms of cumulative. And that would indicate that the weakness has gotten weak enough that's really going to start to hit the market. All right, so as you can see right here, we peaked out, this number peaked out, but the market went sideways and really didn't start to fall apart until we got back under that level. So this too can take a little time to work out. That said, it's high enough so that yes, the market could continue to go up for a couple more days, but looking for consolidation seems like a more prudent way to approach the market for right now. So finally, one other kind of take on the sentiment of the market is the VIX. Now, I think Keith looks at the VIX ETF. I'm currently looking at the VIX index itself. And while they both are basically looking at the same thing, the numbers are different. So I just want to point out that when we sold off, we got to the upper end of this index's band for the last year. So now that we have rallied back, where is it relative to the range for the year? And it's more like I would call it the middle. I would be more, I don't want to focus on the VIX until it gets one extreme or the other. It's sitting right here. You can see it's not at one extreme or the other. So has the market gotten to the same level of complacency that it was the last time it was at these levels? No, absolutely not. Does that suggest we could go higher based on the VIX? It does in a sense, but we don't tend to look at the VIX on a day-to-day basis being that accurate of a predictor. It's much better when it gets to the extremes. So it's not at an extreme right now. So all this added up would leave me with a relatively simple game plan. Game plan for the coming week, as I've pretty much stated, would be to look for some consolidation, trade the stocks. You could trade on the bullish side or the bearish side, because there are plenty of stocks that have not recovered and will look good in terms of rolling over. But in terms of the overall market environment, the cues, you need to look for support back at these prior highs, and I'd be looking at the Thursday lows. Essentially, coming into this week, my bigger picture perspective would be, until we take out those Thursday lows and really get a pattern that's negative, it's pretty hard to count this bull out. That said, if we do break those, this divergence, remember, 3 out of the 4 are nowhere near. Well, I shouldn't say that. SPYs are close, but they are not breaking out to new highs. So the cues look strong and ready to go, but everything could use a break, and 3 out of the 4 haven't made new highs, and that's a huge warning signal if the market starts to get weak. So I hope that helps, and we'll see you next week.